Hello, my name is Alex Verge. I'm the President and CEO of Journey Energy. Journey produces about 11,000 BOEs a day, 60% liquids, in central and southern Alberta. But that is just the start of the story. Journey is also uniquely positioned with exposure to a world-class resource play that is now entering full development stage. With this development comes the promise of rapidly accelerating funds from operations on a per-share basis, along with the increase in market capitalization that follows that funds flow increase. In this video, we're going to show you in clear terms what this transformation can mean to you as a Journey shareholder. A lot of what we're going to discuss here is based upon significant assumptions, which we will highlight, the most important of which is the selling price of the commodity itself over the development period. Listeners are asked not to rely on our assumptions, but to do your own due diligence before making investment decisions. Regardless of how you view these assumptions, and regardless of how you view the near-term fundamentals of our industry, you will, no doubt, come away from this with a clear understanding that the Duvernay joint venture for Journey is material and a significant piece of business. Even in the most conservative cases, it ensures the Journey will stand out from our peers. We're going to start by discussing what we've done in 2025 to take away almost all the future risk associated with this play in terms of the geology, reservoir properties, fluid type, and the execution risk in order to hone in on the building blocks that we're using for this model. Putting these building blocks together is primarily a math exercise given the commodity pricing assumptions over the multi-year development period. Key attributes regarding these types of shale resource plays is the consistent and repeatable well results across a large area. This is what lends itself to building a development model such as the one presented here. In a previous video, we discussed the size and scope of the joint venture along with the positioning of the lands in the heart of the oil window. We're going to start this video where that one left off, with what we have done in the fall of 24 and now in 2025 to remove any execution risk pertaining to the development model. We now have 12 wells on production in our joint venture block with Spartan Delta, where the partners control 112 sections of land, with Journey being in a non-operated 30% working interest position. To go with our 3 existing wells that have been on production since 2019, we now have 9 new producing wells that have been drilled and completed by Spartan since the fall of 2024. The 3 original wells drilled by our former partner, Kowitno, KRC, are starred on this map sheet. These wells have each produced close to 250,000 barrels of oil and were considered basin-leading wells when they came on production in 2019. That said, the limited entry completions performed in 2019 probably resulted in a significant amount of sand being placed outside of the 40-meter thick reservoir. So along with this, lower sand concentrations resulted in almost 3 times the water usage, decreasing well performance and increasing costs. From 2019 to 2024, many operators in the area began to refine the completion design, more perf clusters per stage, more uniform stages, higher sand concentrations, and less water usage, resulting in wells that come on with significantly higher initial production rates and vastly superior early performance than the previous wells. Spartan drilled 2 wells in late 2024 that came on toward the beginning of December. These wells are marked on the map sheet as number 1 and 2. Early performance from these wells provided Journey with enough confidence to increase our oil recovery type curve for these and for future wells. In the first 7 months of production, these wells returned 78% of their capital investment. The average price of WTI during this 7-month period was below $70 US a barrel. And that is a testament to the robust nature of these play economics. These wells were followed up in the spring of 2025 with a 3-well pad drilled from the 6 of 4, 43-3 West 5 surface location. These wells shown as point 3 on the map sheet. These wells came on in the second quarter with 30-day AIP rates that were press released by the joint venture participants on July 7, 2025. Early indications support these wells being as good or better than the initial results. Later in the second quarter, Spartan completed 4 additional wells from the 2 of 22 42-4 pad. These wells are marked number 4 on the map sheet. Journey has no reason to believe that these wells will underperform expectations either. So let's look logistically at what we've done and what has occurred since 2024. 27,500 horizontal meters of lateral length has been stimulated. Over 650 individual fractures have been performed. Over 400,000 cubic meters of water and 55,000 tons of sand have been placed. 3,600 and 3,900 meter lateral completion lengths have been tested. 4 wells have been drilled in the upper portion of the reservoir and 5 wells have been drilled in the lower portion of the reservoir. We've tested 3 different frac companies. Given all of these variations in the data, the expectations would be for a wide variety of outcomes. However, when all said and done, the similarity of results across a wide part of the JV lands is remarkable. There have been very few mechanical issues associated with the program. The costs have been as forecast with minimal overruns. And this all bodes very, very well for the future development. In terms of the aerial extent, if we include the results from the other operators to the north and south of us, the entire reservoir geological risk has been eliminated. If we look at just our existing joint venture wells alone, they span over half the JV lands and they prove up the entire number of wells that are going to be required to execute the development plan presented here. So on this chart, we show the oil rate versus cumulative oil type curve, which was based upon the 3 starred wells on the previous map sheet, those 3 original wells. Please note the consistency of the wells. Even though the 13 and 2 wells 8 miles away from the other 2, they're all behaving the same. Now, above it, you can see the new type curve, and you can see the performance of our new wells relative to that type curve. The first 5 wells are currently exceeding that new type curve. Over the life of the development, we feel that this type curve could represent a good average for the complete development, and it may even prove to be conservative. Under the assumption that this type curve is valid and a representative of current and future oil rate versus cumulative oil production for a 3,600 meter lateral, under our capital assumptions of $12.5 million per well, you can see the single well economic parameters on the table in this chart. Each well is forecast to deliver an NPV at 10% of approximately $11 million, assuming the commodity price assumptions dictated by the 3 consultants' average reserve report pricing as of January 1st, 2025. Price of oil is obviously a key assumption in this analysis, and oil price volatility and fluctuation will significantly impact the results. But that said, the oil price used in this reserve report represents a WTI price of $76.60 US per barrel over the 2025 to 2030 time period. This appears reasonable when you consider the average price of $79.33 US per barrel for the 2021 and 2024 post-COVID period. And then you can also consider the average price of $76.60 US per barrel over the 2023 to 2024 time period. Obviously, the price when the wells come on does matter materially in the economics. But if you apply this same type curve on a well-by-well basis over the development plan period, it yields a rising production curve peaking at 8,000 BOEs a day at some point in the middle of 2030. The model anticipates accelerating activity early in the year, bringing on the wells in mid-year. This is by design to take advantage of the availability of water during the spring runoff. This may not always be the case, but most wells are expected to follow this timing. To achieve this plan, in addition to the wells already on production, Journey is planning on participating in 12 gross 3.6 net wells in 2026 and 16 gross 4.8 net wells in the 2027 to 2030 time period. Accelerating drilling beyond these levels is possible, and it will just involve more capital and more production. 83 wells are drilled as part of this plan. That represents less than half of the total locations that we have. We have over 200 total locations. In order to accomplish this plan, over $1 billion in capital will be spent, and $300 million of that is net to Journey. And although that seems like a daunting task, it is critical to consider the amount of cash spun off by the asset during this period. This is especially true given the comment that I made before that the first 2 wells returned 78% of their capital in the first 7 months at WTI prices averaging less than $70 a barrel. Here's a hypothetical cash flow profile given the assumptions discussed. The green curve shows how the cash return increases on a monthly basis over time, but it also shows how the capital impacts the cash flows. More important curve is the red curve, which shows the cumulative cash flow over time. The curve shows the model becoming self-funding in 2027, and by 2029, we've actually pulled more capital out of the model than we put into it. By 2030, we have Duvernay oil production peaking at 8,000 BOEs a day. And by the end of 2030, we pulled out more money out of the Duvernay than we put into it. So what does this mean? This means that we can pay off our debt and use our cash flow from our conventional legacy pools to maintain or slightly grow our production from those pools during the planned period. Although many factors have the potential to derail or detract from this plan, even a materially poorer outcome than the one presented herein is great for Journey in every way. In terms of translating value to the existing Journey shareholders at a $47.50 netback, and the current netback is actually $56 a barrel, 6,500 BOEs a day of oil production in the Duvernay in 2030 translates to $115 million in annual operating income. And Journey trades at 3 times operating income, which gives us an increase in market capitalization of close to $5 per share. That's an increase of over 200% from where Journey trades at today, so going from $2.50 to $7.50. Again, this is just the start of the story, because even after this plan is done, we'll still have 7 years of inventory left beyond 2030, and this cash flow and this free cash can be returned to Journey shareholders. Any way you look at this, the Duvernay will transform Journey and continue to reward shareholders for years to come. Our Duvernay land is in the thickest shale, in the heart of the oil window. The reservoir is consistent across the joint venture area, and wells miles apart show similar results. The play has largely been delineated to remove all geological and reservoir risk, and the 2025 activity is removing all logistical risk, and that clears the runway for 2026 and beyond. The Duvernay is an incredibly exciting opportunity for Journey and for our shareholders. That's why we own it. That's why we're actively buying more. Thank you for listening.